have more legislative victories than any other president, not including this, but this is the capper because this is, again, the biggest tax cut, biggest reform of all time.
And so it was done. With the stroke of a pen just over 2 years ago, President Trump approved the biggest overhaul of the U.S. tax code in 3 decades. And more tax cuts might be coming. How might all of it affect your retirement plan? It's time to tune out the hype and focus on the facts that matter to you, the income generation.
Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio.
I'm Jeffrey Small, guest hosting today for David Scranton. As everyone knows, passing the Tax Cuts and Jobs Acts was one of President Trump's top priorities when he took office in January of 2017. On December 22nd of that year, he made good on his promise and officially signed the tax bill into law. Though the Tax Cuts and Jobs Act continue to have its critics, it's hard to argue with the positive economic impacts of the law so far. We touched on some of those impacts on a recent episode of The Income Generation. Today, we'll take a closer look at the issue and what the Trump administration's tax policies might mean for the economy and the financial markets going forward. We'll also focus on President Trump's sweeping regulatory reforms and where plans stand for the administration's proposed tax cuts 2.0. Joining me will be Peter Schiff, the chief economist and global strategist of Euro-Pacific Capital, along with Logan Mohtashami, a financial writer and blogger covering the U.S. economy. He's also a contributor to the Housing Wire. First, let's review some background of the Tax Cuts and Jobs Acts and discuss some of its most significant outcomes up to this point. The main component of President Trump's tax reform package involved reducing the corporate tax rate from a maximum of 35% to a flat 21%. It also decreased the tax burdens on individuals and families in several ways, including reducing the Obamacare mandate and doubling the standard deduction. Even before the tax bill was passed, the stock market surged. Wall Street was clearly optimistic about the corporate tax cut, especially with its potential to jumpstart economic growth and the job market. And rightly so, for the most part, especially where jobs are concerned. According to the latest report by the White House Council of Economic Advisors, data across a wide variety of metrics shows that the U.S. labor market is the strongest it's been in the last half century. According to the report, the Tax Cuts and Jobs Acts, in conjunction with other initiatives, has greatly boosted job creation and lowered barriers that made it difficult for many Americans to enter the labor market. The U.S. unemployment rate reached 3.5% in 2019, the lowest rate in over 50 years, and the share of the population on unemployment insurance dropped to its lowest level since the 1960s. None of this should be surprising when you consider that job growth was the primary objective of the president's plan, which is why it was called the Tax Cuts and Jobs Act in the first place. The Trump administration's pro-growth policies have created a surge in labor demand, leading to there now being more job openings than there are unemployed people. According to the Council of Economic Advisors, this is the first instance of this happening since data began being collected in 2000. But that's not all. The following are some other key findings in the Council of Economic Advisors report regarding job growth. Since the 2016 election, the economy has added more than 7 million jobs, far exceeding the 1.9 million predicted by the Congressional Budget Office in its final pre-election forecast. The prime age labor force has grown by 2.1 million people since the election, reversing losses under the previous administration. And these historic gains have been most beneficial for many disadvantaged Americans previously left behind. The African American unemployment rate has hit its lowest level on record, and series lows have also been achieved for Asians, Hispanics, American Indians, and veterans. People without a high school degree, those without disabilities, among others. Even many of the president's critics have been surprised by the continued strength of the job market, particularly as some other areas of the economy have slowed. And the president's policies have not only led to more jobs, but also to higher pay. For 16 straight months, annual nominal wage growth has been at or above 3%, a level not reached since before the Great Recession, and it continues to outpace inflation, according to the Council of Economic Advisors. With more Americans working and having more disposable income, it's not surprising that consumer and business confidence has also increased in the wake of tax overhaul, and by many measures, they remain high. Consumer confidence saw another spike in December as a result of November hiring surge and strong holiday sales. And so, looking back to the stock market's jump prior to the Tax Cuts and Jobs Act being approved, in some ways you can say that Wall Street's optimism was justified. Job growth is obviously one of the most important indicators of economic strength, and it remains a highly positive indicator more than 2 years after the tax bill became law. And while GDP growth hasn't maintained the 3 or 4% levels targeted by the Trump administration, it has generally been strong. And like the stock market, GDP growth also has been affected by the president's ongoing efforts to renegotiate unfair trade agreements. I'll talk more about that later in the show. Coming up, we'll take a closer look at the regulatory changes imposed by the president in conjunction with his tax plan and their economic benefits so far. And later, we'll discuss the current tax status of Tax Cuts 2.0 and what investors in or nearing retirement should know about it.
Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more.
Hi, Peter Schiff. How are you today? It's so nice to have you here with us. You've got an incredible following in the world of finance globally and domestically, and so we're glad you're with us.
My following is on the fringes, at least as far as I know.
Well, you have a pretty big following from what I see out there. But anyway, as far as the fringes go, we're living on the fringe financially. We have crazy fiscal and monetary policy in place. We're living in this era of liquidity where we've got this tremendous liquidity rally and we're at the debt maximums across the board on different areas. How long can this rally continue, Peter?
Well, I don't know. I mean, it's already, I think, living on borrowed time, literally. And, it's not really just liquidity, it's inflation. And that is the best way to describe what is happening. You have massive inflation being generated by global central banks. And that inflation is finding its way into stock prices and bond prices and real estate prices and to a limited degree, consumer prices. I mean, consumer prices are rising, they're not falling. And I think they're rising faster than the government admits with their measures, their official indexes. But I think that a lot of the inflation is showing up predominantly in these financial assets. And so when that happens, people are not concerned about inflation, but inflation is still doing a lot of damage to the economy. And ultimately, no matter how inflation enters the economy, it ends up in consumer goods. So that's where it's all going. So right now, it may be temporarily hanging out in the stock market and people feel richer, but when it ends up in the supermarket, they're going to feel a lot poorer.
Those are all really good points. But we've had a heck of a melt up here under the Trump administration. As you were watching, the theme of our show was the tax cuts and what Trump has done from deregulatory perspective and the China trade deal. How has that benefited the economy, and what do you see happening in the future?
Well, I don't think anything that Trump has done has really benefited the economy. I don't think we've done anything to, deal with the long-term problems, the structural imbalances that have been plaguing the economy. I think all we've done is inflate a big bubble. But we did the same thing under Obama. We did the same thing under Bush. We did the same thing under Clinton. So this is business as usual at the Trump White House. We did get some stimulus, which we've had before, where you cut taxes and increase government spending, and now you get a temporary boost as we spend all that borrowed money. But when the high wears off, you find yourself in a very deep hole, and that's exactly where we're headed. I think where we're going now is going to be into a much worse economic environment than what we had in the Great Recession in 2008. The payback from this high is going to be much bigger than the payback from the previous time the Fed did this.
You know, I couldn't agree with you more. We have this new addiction of liquidity and debt. And if that starts to curtail or fall off or get withdrawn or de-escalate, what's going to happen is we're going to feel the economic effects, and asset prices will drop, the economy will slow down, and then we've got the political risk quotient here that's going to happen. If we have a downturn, we'll probably see the country go socialistic, and that has its own problems.
And it's not really about the economy slowing down. The economy never really sped up. I mean, it's about the bubble deflating. I mean, the bubble certainly got bigger. There's no disputing that fact. But if you look at what's going on in the U.S. economy, we have record budget deficits. Our budget deficits are soaring. That is not consistent with a strong economy. If you have a strong economy, the government benefits from that strength because it collects more in tax revenue and it doesn't have to spend as much on social safety nets. So normally when the economy is booming, the deficits are shrinking. Instead, our deficits are going the other way. Also, look at corporate profits last year. They actually declined. How can we have a boom, but businesses are making less money? So there is no real boom. It's just a fantasy that's being created by the Fed, but being perpetuated by Donald Trump, who wants to take credit for an economic boom that only exists in his imagination.
Interesting comments, Peter. Well, listen, we've got to take a break. We'll be right back.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan.
One of the first things Donald Trump did as president was to tell a group of business leaders that his administration would cut regulations by 75% or maybe more. Whether that boost was serious or not, it certainly showed the president had big ambitions when it came to eliminating and reducing red tape. As a businessman himself, he knew overregulation was creating unnecessary hurdles for businesses and impeding economic growth, not to mention wasting taxpayer dollars as well. So nearly a year before his tax reform package was approved, President Trump issued an executive order which required agencies to remove 2 old regulations for every new one they issued. It also instituted a regulatory budget requiring that each agency impose 0 or negative new net costs over the course of the year. The president also urged Congress to reverse several regulations issued at the end of the Barack Obama's presidency and issued another executive order to appoint regulatory reform officers to every government agency. Although efforts to repeal and replace Obamacare have not yet been achieved, the Trump administration has managed to make the program more flexible for states and individuals through deregulation. In addition, the FDA has sped up its drug approval process, especially for generics, and potential abuses by regulatory agencies will now be better policed, thanks to 2 more recent executive orders. The president has also established the Governor's Initiative on Regulatory Innovation, which is working to do 3 things. 1, reduce outdated regulations at the state, local, and tribal levels. 2, advance job licensing reforms. And 3, align state and federal regulations. In all, according to the White House Council of Economic Advisors, President Trump has rolled back nearly 8 regulations for every significant new one created since taking office. And these efforts have slashed regulatory costs by more than $50 billion. According to the White House, deregulation is saving small businesses from wasting time and money on compliance costs, while also making it possible for more small businesses to offer their employees retirement plans. With that in mind, how else might all this deregulation benefit everyday Americans for saving for retirement? Well, in the coming years, the Council of Economic Advisors estimates the average American household is projected to see an income of $3,100 per year thanks to these regulatory reforms. It also estimates that 20 major deregulatory actions undertaken by the Trump administration will save American consumers and businesses over $220 billion per year. And that 16 pieces of deregulatory legislation are expected to result in a $40 billion increase in annual real incomes. Naturally, not all of the president's efforts in the area of deregulation have been popular. His 2017 decision to withdraw from the Paris Climate Accord was condemned by many environmentalists, along with his repeal of the provisions in the Endangered Species Act. And he's reining in of his powers by the Environmental Protection Agency. Some have also criticized his rollback of certain provisions in the Dodd-Frank Wall Street Reform and Consumer Protection Act, which was put in place in the aftermath of the financial crisis to improve the regulatory oversight of the banking and financial services industries. Of course, not every decision is going to please everyone, and every administration has difficult decisions to make when working toward specific goals. But if the president's goals around the deregulation and tax reform were to boost the economy, create jobs, and increase the earnings power of everyday Americans working toward retirement, well, again, it's hard to argue with the president's results. With that in mind, it's certainly likely that the president will focus heavily on his economic record as he campaigns for re-election in the months ahead. As part of that effort, he is expected to announce details for Tax Cuts 2.0 and to make further progress in his trade negotiations with China. I'll talk more about all of that in just a bit.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks, but yet you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement.
So Peter, you're the president of Euro Pacific Capital. So Euro Pacific Capital, do you guys focus on Asia or do you focus on global trends or domestic trends? What is your main focus at Euro Pacific Capital?
Yeah, well, first of all, right now I'm basically the chief market strategist and economist. I used to own the business, but no longer. I now work for my asset management company out here in Puerto Rico. But we do manage accounts through Euro Pacific, which is now a division of Alliance Global Partners. And we focus on international markets. We focus on non-dollar investments, equities, and to a lesser extent, bonds. I think the most important thing that U.S. investors can do is abandon ship before it sinks. And it's not just getting out of the U.S. stocks and the bond market, but getting out of the dollar. That is the biggest problem. That's likely to see the biggest loss. So while I think U.S. stocks are going to go down, and I think investors will lose money over the next 3 to 5 years in U.S. stocks, the money they don't lose is even going to lose more value. So you got to get out of the dollar. But we also focus on commodities, on gold. I help people buy physical gold as well as invest in the mining stocks. I think the home runs, the 10 baggers or more of the next 5 to 10 years are going to be found in the mining sector. I think the price of gold is going to surprise a lot of people by just how high it goes. I mean, the last time in 2011, we peaked out at 1,900. Right now, we're just over 1,550. We're up about 50% over the past 4 years. But I think we're going into completely uncharted territory in the price of gold. And I think the mining stocks are not priced for this at all. I think the mining stocks are priced for the gold price to go down. They're ignoring the fact that gold prices are rising. And there's a lot of skepticism there. There's nothing but optimism about U.S. stocks. People are, chasing the market to new highs and bidding up prices. But they're not doing that with the mining stocks. I think they will eventually. I think there's going to be a speculative phase years from now in that sector, but we're not there yet. Right now, smart money are accumulating these stocks, and that's what we're helping our clients do through separately managed accounts and through a mutual fund that we manage, the Euro Pacific Gold Fund.
So yeah, you stole the next answer to my question. For the average investor, average retiree today, because we could be looking at those inflationary components and commodities in the near future, what percentage of someone's portfolio would you advocate towards gold?
Well, physical gold versus mining stocks, very different types of investments. Mining stocks are speculative, and you're betting on the fortunes of a company, and you're subject to the vagaries of costs and earnings and political risk, depending on where their mines are located. So that is part of a speculative portfolio. But I think every investor, particularly conservative investors, need to have at least 5 to 10% of their portfolio in physical gold, maybe even more, given how overvalued U.S. stocks and the U.S. dollar is, and especially if you're nearing retirement. I mean, that is the key. Inflation is going to wipe out the retirement for most Americans. I think most Americans who are nearing retirement age will never retire. And I think most Americans who are already retired are going to be re-entering the workforce, because I think their money is going to end up retiring, not them. And so you need to be cognizant of this, especially, if Trump is not reelected and we get a President Bernie Sanders and we get a Congress that is sympathetic to the way he wants to remake America as an even more socialist economy. And he wants to introduce all sorts of government provided, benefits, free education, free health care, government jobs. All this stuff that they want to do is going to cost a fortune. And yes, they want to raise taxes on businesses and the rich.
Peter, let me interrupt for a minute. We'll come back to that point in a minute. Let me interrupt. So yeah, everything free is not good for the economy. So we'll be right back with more right after this break.
Would you take your grandchildren out for ice cream and try to pay for it using your stock certificates? No, that would be ridiculous. Instead, you would use your income. So why then do so many retirees make one of the biggest financial mistakes, dipping into their savings instead of relying on income during retirement? The good news? It's completely avoidable. To learn more, visit theretirementincomeStore.com.
As mentioned earlier, and as Dave has discussed many times on this show, the stock market has been greatly impacted by President Trump's efforts to renegotiate unfair trade treaties, particularly with China. The market basically traded sideways for all of 2018 and much of 2019 and experienced major bouts of volatility, largely due to the expanding trade war between the United States and China. China's stock market and economy have also been hampered by the trade war as well, and financial markets all over the world have felt some impact. Therefore, it's hardly surprising that Wall Street has rallied in a big way in recent months as the prospect of this deal to de-escalate the trade war has moved forward, culminating with the signing of the Phase 1 of a preliminary trade deal between the two superpowers on January 15th of this year. The stock market has hit multiple new record highs since talk of this trade pact first emerged in late October of last year. Just a few weeks before that, however, the market was only slightly higher than it had been in January of 2018, when fears about the pending trade war first started to rattle investors. The point is, the trade war issue has clearly had a major impact on the stock market. And in the past few months, that impact has been positive for the first time. With that in mind, don't be surprised if President Trump seeks to sign Phase 2 of the trade deal at some strategic point in his re-election campaign in the coming months. If doing so gives the stock market another boost as Phase 1 did, odds are his poll numbers could see a boost as well. And as a master politician, he knows this. In that same vein, the White House has already said it plans to unveil details about its next proposed round of tax cuts later this year, closer to the November election. Again, in purely political terms, this is a smart strategy since President Trump's economic record is his main strength as a candidate. Will Tax Cuts 2.0, as it's being called, boost his economic achievements even further? No one knows, of course, and details of the plan are still being worked out. But there are some things we know about Tax Cuts 2.0 already. The main focus of 2.0 is on boosting take-home earnings for the middle class, an initiative being spearheaded now by the National Economic Council Director, Larry Kudlow. One proposal calls for reducing the 22% marginal tax rate for the middle class to 15%, which Kudlow said he believes is a good idea. It might also help to equalize some of the imbalance in the first round of the tax cuts, in which many households with middle and lower incomes saw their taxes reduced by proportionally far less than those with much higher incomes. Another primary objective of Tax Cuts 2.0 will likely be to make permanent several of the first tax bill's temporary cuts for individual taxpayers, some of which are scheduled to expire at the end of 2025. Beyond that, the details of Tax Cuts 2.0 will likely remain uncertain until the Trump administration unveils them in the midst of the campaign season sometime this summer. No one can predict what impact it might have on voters or where the economy and financial markets overall might stand. By that point, yes, the stock market may still be riding high, and it may have soared even higher if Phase 2 of the China trade deal is signed by then, as we've mentioned. But if you're retired or within 10 years of retirement and still have a large part of your savings in the stock market, be aware that a drastically different scenario could play out as well. I'll talk more about that in just a bit.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementincomestore.com.
Now let's welcome back Peter Schiff, Chief Economist and Global Strategist of Euro-Pacific Capital. Peter, thank you for sticking around. It's so awesome to talk to you. I've been an admirer of yours for a long time, and I've seen you on all the major networks, and you've got quite a following in social media, even though you're humble about it to a certain degree. Interest rates. There's been a lot of talk about interest rates. I hear a lot of the pundits on the major networks talk about rates going up in the fall, and I don't see how it's physically possible for interest rates ever to really go up ever again. Because there's just too much debt. We have too much debt. In December of 2018, the debt service with those 3 rate increases that year would have increased from $200 billion as an average to $800 billion just here domestically, and we simply don't have the money to spend on debt service, and neither does the globe. So I think we're in a permanent low interest rate environment. Tell me what your thoughts are on that.
Well, that's not true. I mean, it's kind of like saying, I don't have an umbrella, so it's never going to rain again. It's going to rain. You're just going to get wet. And so their interest rates are going to go up eventually. Now, the government, the Federal Reserve, is doing everything it can. That's why it's back to QE in the repo markets. It doesn't want to admit that that's what it's doing, but it is. But it's doing that to artificially suppress interest rates. Why does it want to do that? Because it knows if it allows interest rates to rise to the level that the market wants them, that we're too broke to afford it. And so we would have another financial crisis. But it wouldn't just be banks failing. The U.S. government would default on its obligations as well. and this would be a much bigger crisis than '08. And so in order to postpone the day of reckoning, the Fed is holding interest rates artificially low. But by doing that, they are worsening the debt bubble. They are making the underlying structure of the U.S. economy much weaker. So we're digging ourselves into a bigger hole, and it means that when the Fed eventually loses control of interest rates, they're going to rise that much more, and the pain is going to be that much greater. And of course, the real risk is that in trying to keep interest rates from rising, the dollar ends up crashing. Because the only way they can keep rates from going up is to keep printing money to buy bonds. But when they do that, they risk collapsing the dollar, and that creates a currency crisis, which is even worse for the U.S. economy. So just because we can't afford to have a bad thing happen doesn't mean that now that bad thing is not going to happen. It just means it's going to be much worse. And what I was saying before about the government trying to provide all this free stuff, it's not free, especially when it comes from the government. They're going to pay for it by printing money, creating inflation, and we're going to wipe out a generation of retirees who have put their trust in the future purchasing power of the dollar, and the dollar is going to be destroyed because they're going to have to run them off the printing presses to provide all these goodies that have been promised. And so to avoid that or protect your savings and your retirement from this massive inflation tax that's going to decimate everybody, you got to get out of U.S. dollars now. You got to avoid that tax by avoiding U.S. markets, avoiding U.S. dollars, own foreign assets, own foreign stocks, own precious metals, own mining companies, because I think that's the only way to secure retirement in America.
Well, those are all good points, Peter. There are different ways to secure retirement in America, but I have to disagree with you on the fact that I think we're going to be stuck in a long-term low interest rate environment simply because we won't be able to service the debt that we've created as the debt monster has expanded into a giant hurricane of potential problems, and it keeps getting bigger and bigger and bigger.
How do you do that? I mean, it's not like a central bank can just decide we're always going to have low interest rates. I mean, because there's a consequence to that, right? Because they have to keep printing money to do that. And so you can't do that indefinitely. You can't. It's like saying, gas is expensive, so we're just going to put a price control and make gas cheaper, or we're going to make bread cheaper. I mean, the government just can't decide that a product should be less expensive.
Well, the government is not the Fed, Peter. The Fed is independent of the government.
But
they're
the
completely
Fed is
separate.
acting as if it were part of the government. I agree that the Fed is supposed to be independent, but it clearly is not. It is clearly acting as if it was a branch of the government, and it is pursuing monetary policy based on a political expedience. If the Fed was really independent, it never would have done QE at all. That's just monetizing government debt. It would have allowed interest rates to rise and forced the government to make difficult political choices, cut government spending, reduce entitlements, raise taxes, whatever. But the Federal Reserve spared elected officials having to deal with that by just giving them a free out, by just printing money. But this has created a much more vulnerable economy, and it has set the stage for a much worse crisis than '08. Because remember, the only reason we had a financial crisis.
Well, Peter, I agree with you. I agree with you on the crisis. I agree with you on the potential of a much larger crisis. But listen, that's all the time we have today. Thank you for the spirited debate. It was great to have you. Thanks for joining us, Peter. Historically speaking, presidential election years tend to be good ones for the stock market. And with an incumbent president whose main focus has been the economy, there's a good chance history may repeat itself again in 2020. But nothing is certain. You don't need me to tell you that for all of President Trump's economic successes, this president remains one of the most dominant political forces in our nation's history. And that's precisely why it's so important to understand the delicate and in some ways disconnected relationship between the economy and the stock market right now. Because as this election year plays out, it's possible that we could see little change in the former, but major change in the latter. In light of all we've talked about on today's show, the president's tax cuts, deregulation, and other efforts, the U.S. economy is still rolling strong with tremendous inertia. Yes, some areas have felt the effects of the trade war and slowed down, but consumer spending and borrowing remain extremely strong, thanks largely to higher wages and the lowest unemployment rate in 50 years. As we've discussed, I believe there's a good chance the economy will remain strong, with GDP growth stable or increasing slightly this year as household spending and consumer confidence offset the effects of the trade war. And if real progress continues to be made on a trade deal, the economic picture may be even brighter. Yet with that said, I also believe that at some point the economy and stock market will have to diverge. If you're a regular viewer, you've heard Dave point that out. Based on historic evidence and economic fundamentals, the market is long overdue for a major sustained correction. And that's true just as it's true that much of the market's growth since the financial crisis has been fueled by artificial stimulus from the Federal Reserve and continues to be. The point is, even if the economy remains stable, any number of factors could trigger the next major sustained market drop, given that two are largely disconnected to begin with. Which brings me back to the election. If as November draws closer, it becomes apparent that voters want a change, corporate America could start making drastic changes of its own. In fact, I think it's very likely corporate heads start battening down the hatches, spending less, hiring less, decreasing stock buybacks, and ultimately driving down demand for stocks. That alone might not trigger a major sell-off, but the results of the election itself could. And there are plenty of other shaky economic and geopolitical factors around the globe that could also burst Wall Street's artificial bubble. The bottom line is, regardless of where you stand politically, if you're retired or within 10 years of retirement, I believe asset protection should continue to be your highest priority, now more so than ever. Now let's welcome my next guest, Logan Mohtashami. He's a financial writer and blogger covering the U.S. economy. His work is frequently quoted in Bankrate.com and Bloomberg Financial. He's also a contributor to Housing Wire. Logan, thank you for joining us today.
Pleasure to be here.
I got to tell you, of all the people that I research and look at, when I look at the information that you provide the public on social blogging in relation to finance, I am beyond impressed because you're about the most honest person out there. You tell the story and you tell it like it is. And so today, as you've been watching, we've been talking about the Trump tax reform policies and what the effect has been on the economy with deregulation and the China trade deal. And we'll talk a little bit about real estate because that's really kind of your wheelhouse. And so, one of the things that affected real estate at the very inception of the Trump tax reform was the decrease in which your ability to deduct off property taxes and mortgage interests got dropped to $750,000. And so, but yet we see housing starts expanding. Can you explain the divergence and the dynamic as to why that's happened?
Well, I think it was a great headline that, the states like New York and California were going to get hit with the mortgage deduction, but realistically, a very small amount of people were going to be impacted. It's because you still have up to $750,000 of mortgage interest rate deduction. So you're talking about the million plus market, which is very small. So it wasn't a very valid thesis to make that the general housing market or even California housing market was going to get hit. What had happened was in 2018, yields went up, rates went up, sales came down a little bit, and people try to correlate that to the tax cut, but it wasn't the case. When interest rates fell back down again, all the markets recovered, new home sales, existing home sales, even California sales came back up to par kind of. So I think that was a great story for people to talk about, but it doesn't really have any velocity to the general housing market.
Huh, interesting. Well, one of the things I wanted to ask you, and so how do you feel President Trump is doing overall in relation to the economy and some of his policies on deregulation, the trade deal? The Fed's been lowering rates, they increase rates, they lower rates. We've got about 15 seconds here, Logan, so give me a quick answer.
Well, I think low taxes and continuing government spending, both those two things together will keep this expansion going out here. And as long as that continues, it's good for this expansion. There's nothing out there that would actually, right now, that would curtail it to any degree.
All right, Logan, thank you very much for that. We'll be right back after this break. Welcome back to The Income Generation. We're talking with Logan Mohtashami. He's a financial writer and blogger covering the U.S. economy. Logan is also a contributor to Housing Wire. Thanks for sticking around, Logan. So we see real estate's peaking at prices again. Mortgage levels are at their highest level pre-2008 or right around 2008. What's driving this expansion at this time in that area? Because the economy is very strong. Is that the reason? Is because of employment? What's the reason those areas are doing well?
Well, I think the discussion with housing needs to be broken into two different categories. The new home sale market is much different than the existing home sale market, but is more important to the economic expansion itself because housing starts are construction jobs and big ticket items. We've had the weakest new home sales cycle ever recorded in history, but we're also running into one of the best demographic patches ever recorded in history. So the slow and steady cycle can still move up higher because if you look at housing starts on a 50-year average, we're not that much higher than where we were decades ago. So we have legs as long as the 10-year yield stays below 2.62%, the cycle can go because housing starts are one of the main things you see that declines into a recession. So low rates, good demographics, no overheating demand. You can look at purchase application data, they're only at 1998 levels. New home sales haven't even closed a year above 750,000. So this has legs because it has not been overheating. And I think that's the key for not only the housing market, but for the economic expansion as well.
Yeah, I agree with you on that. And as long as the lenders don't open up the floodgates and giving people credit that shouldn't have credit, I think we'll be in good shape there. With the foreclosure rates, I think are at 21-year lows right now. What are the default rates on mortgages nationally?
They're actually, yes, they're very low. But the main thing about this cycle is that this cycle produced the best homeowner loan profile ever in our history. If you look at the last 10 years, you have great nested equity, which means that they have equity positions to protect them. FICO scores are very high because homeowners now have very good cash flows, and there's no exotic debt. I think that's the main thing. There's no unique debt structure that recasts or will force a foreclosure. Housing's back to what it used to be. You need a job loss recession first before you see a real expansion in delinquencies, which should be much lower than what we saw in the housing bubble. These are about as the most opposite cycles as we could ever see.
So is that something economically that President Trump could put as a feather in his cap for claims of accomplishments with the best cycle that you said a few seconds ago in history?
Well, as long as the credit doesn't expand out to a kind of a, how should we say it, giving debt to people that don't have the capacity to go debt, you keep the cycle going as is, fine, excellent, because that's a legislative, that's a, congressional, and the president would have to ask for that. We're still good to go there. There's nothing that has been done that would allow banks to facilitate loans to people that probably should not have them. So we're still good to go there.
Excellent. Well, Logan, I want to thank you for being here today, and thanks for joining us. We look forward to talking to you again in the future. Thank you so much. I'd like to thank both of my guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers, and of course, I'd like to thank David Scranton for letting me guest host the show today. The Income Generation is not a show about politics, as most of you are aware. However, we are obliged to focus on politics quite often, because it's simply a fact that political issues matters, and politicians themselves have major impacts on the economy and financial markets. And that, of course, includes your retirement savings, and the question of whether you'll have enough income to meet your retirement needs and goals. So now, as everyone knows, politically speaking, we live in very challenging times. We have a president whose tax reform and deregulation efforts have fueled an economic boom and the lowest unemployment rate in 50 years. Yet even those successful efforts remain controversial, as does the president himself. And we have an overinflated stock market that's continuing to inflate, but not necessarily because of the economy or expanding corporate earnings, which are in decline. The latest rally is based much more on artificial manipulation by the Fed and liquidity coming into the markets. You could say we are having a liquidity rally betting on a Trump re-election. But just as politics may play a role in keeping the current rally going this year, and perhaps beyond, our country is divided by politics and partisanship and political risk has now become part of the 2020 economic theme on the stock markets. It may also play a role in bringing it to a dramatic end and forcing the financial markets to make fundamental sense again, which could happen even if the inertia from President Trump's policies keeps the economy fairly stable. According to the lessons of market history, that could mean sustained market corrections in the neighborhood of 40 to 50%, a loss that would obviously be devastating for anyone in or nearing retirement. The good news, as you know if you're a regular viewer, is that you not only don't have to take that risk in order to achieve your retirement goals, but you could actually improve your goals by reducing your stock market risk. It all starts with finding the right advisor to help you make the shift from a financial strategy focused on growth and capital appreciation to one focused on protection and retirement income. Thanks for watching. If you're close to retirement and really want to know how to maximize and protect your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it, on the Income Generation. I'm Jeff Small, in for David Scranton, and we'll see you next week.